What an exciting video I have for you today. This is dividend investing. This is where we invest for dividends, for passive income. One of the stocks that I own today completely exceeded analyst expectations in their earnings report. And I am so proud of them, so happy for them, because this is a stock in the sin stock sector, a stock that the media out there, they just hate this stock. And so it makes me so happy to see them thriving. Another topic in today's video, I'm going to go over yet another undervalued dividend stock pick. My last video, I did 3 undervalued, ridiculously undervalued dividend stocks. I'm going to share another one with you today. And then I'm going to close out the video today with a subscriber question. A subscriber who asked me a question about GM and Toyota. He's been waiting a while for this answer, so I'm excited to deliver it today. This is going to be such an exciting video, but before you even get started here, this is Thug Life dividend investing. And if you appreciate hip-hop music the way I do, make sure to check out this track by Trinidad James, All Gold Everything. Do not listen to this at work. It is not work friendly. Do not listen to it in front of kids either, not kid friendly. But this song, this is how I feel today. This song embodies how I feel today about being a dividend investor, about straight Flexin out there, because despite all of the haters in the world, the stocks that I own that I'm going to share with you today, they are through the roof. We are getting rich. We are making money. Dividend investors, despite all of the haters, all of the media out there, which quite frankly, I think have malicious intentions, we are doing great. So get excited for a Thug Life dividend investing video. So I've got my laptop here again. I'm going to use this because I've got a bunch of stuff here on the whiteboard, but it is not as much detail as I've got on here. So bear with me here. This is a video in real time, and I spent a lot of time researching here, so I am really excited here. Anyways, PM, Philip Morris up 9% today. That's the stock price. It's trading at $88.22. They pay a dividend of $1.14 a quarter. And again, this is a channel about dividend investing. I invest for dividends because I will pay all of my bills with dividends. Annual dividend, when you add up the quarters, is $4.56. Basically, if you were to buy Philip Morris today, anyone to buy today, the starting yield is a 5.2%. Respectable starting yield. And that's nice. The 5-year dividend compound annual growth rate, it's only 4%, so they're not growing the dividends that quickly. Out of the space, I believe Philip Morris is the most richly valued, and you'll see that in a minute based on the PE ratio. The reason, quite frankly, that it's so richly valued is BTI and Altria is 100% US exposure. BTI's got a lot of US exposure. And the US landscape of these products, it's more stringent, it's more strict, and there's more worry out there. And so that's why these two are trading at much lower PE multiples. The earnings per share for Philip Morris came in at $1.46. So this is the second quarter earnings. They came in at $1.46. Now this is 11% greater than the analyst expectations. And analysts who follow these companies, they're generally pretty good at what they do. There's a lot of analysts following this company. And so the fact that they beat those estimates by 11%, that is fabulous. Revenue came in at $7.7 billion. This was 4.3% higher than analyst estimates. So again, this company is growing. They raised their 2019 EPS guidance. So they literally said, hey, Wall Street, we previously told you that we were going to come in here. We're going to be coming in way up here. So they raised their guidance. Only a company that is doing really well would raise the guidance. And they raised it from $5.09 per share to $5.14. So it's just fabulous that this company is doing so well. Now, what I want to point out, though, is on the $5.14 guidance, if I take the current share price, which is just mentioned at $88.22, I divide by what they said the guidance will be, which is $5.14. That puts the forward 2019 PE at 17. So 17 for a sin stock, doesn't have exposure to the US. It's like a fair PE. It's certainly not a bargain basement discount, but I certainly don't think Philip Morris is a screaming buy here. I think BTI and MO are better buys because they have that US exposure and therefore they are trading at much lower PE multiples. And so, needless to say, it's an okay buy, but the excitement here is this is a bellwether for the category. All ships are going up because what Philip Morris proved today is the media. The media who's just posting this fake news about volumes going down, about this and that, they are wrong, and the numbers prove them wrong. And I'll share with you some more numbers. Revenue is down 0.3% year over year, but that's because of currency fluctuations. If you take out the currency, revenue is up 5.4%. Let me repeat that. For a quote-unquote dying business, that is the worst thing in the world that the media paints it to be. They want to take away the freedom to even enjoy these products. Revenues are up 5.4% year over year. That is a thug life moment. Earnings per share are up 3.5% year over year, and operating margin has improved from 40% to 41.7%. So this company, Philip Morris, is doing just fine despite what everyone would lead investors to believe. And this is what I tried to plant the seed. I tried to share some of this in my previous videos. I'll link in the description below. But I've been owning these sin stocks forever. And I've been reinvesting my dividends as of late, even though these positions are already so big in my portfolio. Almost 20% of my dividend cash flow comes from sin stocks. If you want to learn more about that, I'll link in the description below. You can download my entire portfolio. I don't like having so much concentration in one sector, and so I want this sector to be smaller in my portfolio. And the way I'm going to do that over time is I'm going to take my dividends from these companies and reinvest them elsewhere. But right now I am reinvesting back into these companies just because I believe they are good values. And anyways, I even bought more of them. I bought more BTI, I bought more MO a few months back. And so I shared that on the YouTube channel as well. This was late 2018, early 2019 when I was buying more of these companies, even though they're already huge in my portfolio. And I did that just because I saw the value. And so I know a lot of you out there did as well. And this is just a day to celebrate. Now, I will tell you something very interesting. The traditional product that they sell, it's down 3.6%. 3.6%, by the way, is not so bad. Now, what really excited me is I've been talking about this a little bit. I've been planting the seed. And if you're on Twitter, follow me. I'll share in the description below the link. But if you're on Twitter, you already know this. I've been talking about their heated product. They make a product called IQOS in contrast to traditional combustible product, the heated product. Apparently it's more health conscious, it's better for the health. And so IQOS sales are up 37% year over year. So this old world company, they're actually being disruptive here. They've created a new technology, they've created a superior product. It is the heated IQOS product. And that IQOS, by the way, in April this year, got FDA approval to start testing it in the United States as well. Altria will be doing this, not Philip Morris, their counterpart Altria. And this is a breakthrough in my opinion because it's a disruptive product. It's an increased health product. It's better supposedly for one's health. And consumers love it, especially consumers in Japan. And so the key takeaway here is be so careful as an investor. I always have to remind myself, the media, they want to get in your head. They want to sometimes spread fake news. They want to sometimes, quite frankly, limit freedoms. And this is why I am so passionate about this. Look, I understand that something like this does contain health risks, but in general, I believe that responsible adults should have choice to use certain products in moderation. Quite frankly, there are a lot of things out there that are not ideal for one's health. Honestly, almost everything out there is not ideal for one's health. One could say that being on a smartphone all day, hunched over looking at it, that is bad for health. And quite frankly, those types of things, they hire PhDs at those companies to try to keep people on the smartphone. At least that's what I've heard. And so that it could be dangerous for one's health. Going to a restaurant and eating a hamburger could be dangerous for one's health. I go and I drink a lot of coffee. Having too much coffee, especially those nice sweet drinks with all of the whipped cream on it, like I like to enjoy, that may not be so good for my health. And so there are so many things out there not good for someone's health. But what I'm saying is, if you're a wise adult, if you practice moderation, shouldn't wise adults practicing moderation have the freedom to choose? They should have freedom. That is what, in the United States at least, that's what we're all about. That's what our forefathers fought for. That's why that's what this country was founded upon. And so it just really, I get so passionate when the media attacks these types of companies and they go after them. And the ex-FDA commissioner, for example, even though he's not even part of the FDA anymore, still sometimes comments about these companies, oftentimes, quite frankly, in a negative way. When these companies they're paying their fair share of taxes. They are providing, in my opinion, a service to society. Some people during their break like to take a break from work and enjoy responsibly these adult products in a responsible adult manner, and it provides value in their life and it provides a break from their workday. And so who am I to judge or say anything against that? And this is why when it comes to the media, just be careful about their agenda, what they're saying. Even if they're quoting numbers, you have to be careful, because there was this report that came out a month or so ago and it said, hey, volumes are just tanking. Well, look, I didn't write it there, but on my computer, it's only down 3.6% year over year, and the heated product is up 37%. And so the media, they were citing this study that made you feel like it was just falling off a cliff, the volumes. And so they're not, because the study was biased. And so the study was inaccurate. And so at the end of the day, the takeaway that I have, be careful for fake surveys, be careful for fake news. Look at the raw data from the companies. Now look, if you have a moral opposition to something like this, you don't like it, that is totally cool. And so I think everyone as an investor has to identify their own values. They have to identify where they stand on topics, and they have to stand behind those values. And I think that's so important. And I know there's members of the community here, one who even engaged with me on Twitter earlier today, who said, Ian, I respectfully disagree. I don't like these companies. Gosh, I appreciate that, and I respect you. I respect your opinion as well. This is just my opinion. But I just got to do a little bit of straight flexing today on this stuff, because these companies never get anyone talking about them positively. Never. It's all negative all the time. And so I just want to do a little bit of straight flexing. And this is what it comes down to as a contrarian investor, as a value investor. Sometimes you have to put your foot out there. You have to take calculated risk when the world hates something. And that's what I've been doing since day one with SIN stocks. I know some of you out there are doing it as well. And this strategy is very painful. It's very difficult, because everyone, if you go to work and you're doing water cooler talk and you tell them, hey, I own Philip Morris. You do that here in the Bay Area, you may get fired from a company for saying something like that, because the companies around here, they are so against this kind of thing. It's such a unique political climate here in the Bay Area, where you may not be able to even have that kind of conversation at work, because people are so opposed to this kind of thing. And so just because that's what I deal with sometimes, and I live around and I hear about it, I got to just celebrate this a little bit here, because I think these companies are doing some good things now, and I'm just excited to see them going up. So this is segment one for the video today, straight flexing. I want to move on now to some more straight flexing, quite frankly, because IBM, Big Blue. Man. Okay, so I'm on a roll today. I know, I hope I'm not pissing anyone off. I hope you guys enjoy the video today. Yeah, I don't get a lot of thumbs down. We'll see. I know I'm coming strong, but that's just the kind of mood I'm in today with this stuff. IBM, everyone hates this company. Oh, if you're a tech investor, you better be buying the FANG stocks. Don't go near old Big Blue or Big MO. Anyways, IBM. I've been talking about it for a while. I'll link in the description below. I still believe, quite frankly, that this is a screaming buy, that it's a huge value, a ridiculous value. Just like the three stocks I talked about in the last video, I will probably be buying some more IBM. I wish I bought a little more lower, but sometimes when there's a lot of opportunities in the market, you got to pick and choose, and IBM just wasn't on my list at the time because I wanted to go for some other stocks like 3M, makers of the whiteboard here. Anyways, IBM, it's up almost 5% today, Thug Life, and they pay a dividend of $1.62 a quarter, annual that's $6.48. Basically, someone that buys right now, the starting yield is 4.3%. Now, what's really fabulous about IBM is the analyst consensus estimate for 2019 is $13.90. The analysts expect the company to earn $13.90 in 2019. If I take the current share price, I divide by those expectations, PE is a 10.8. Let me repeat that. Philip Morris, we just looked at PE of 17. I think it's kind of fairly valued. I'm still excited it's doing well and the whole sector is going up. IBM is at a 10, people, a PE of 10. And that gets me excited. So we'll talk more about that. But one thing before I do that, people ask me, Ian, why do you look at forward PE? This is a question I get a lot. I started looking at forward PE a few years ago. The reason I did it a few years ago is the tax law was changing and a lot of the backwards PE data was just skewed because it was looking at GAAP earnings and GAAP earnings were off because of one-time tax things. So I just started looking at forward PE. Once I started looking at forward PE though, I started getting more and more comfortable with it and now it's kind of all I use and I'll tell you why. Originally, it was just to get around the tax stuff because GAAP earnings were just thrown off because of one-time tax stuff. Now, though, the reason I like forward PE so much is twofold. One, especially as you get later in the year, like we're in now, half the year is over, analysts have half the year's worth of data on which to base their estimates. And so the estimates, especially as you get later in the year, they're pretty accurate. They're pretty close. The second reason, though, I like forward PE is the market is forward-looking. Yeah, the market kind of cares what happened in the past, but stocks are generally valued based on the future. And so if I can look a little bit in the future, towards the end of this year for 2019, I think it's a better way to evaluate stocks that I'm looking at. And so I like to look at a forward PE. My philosophy on that has changed over time. It's pretty much all I look at now. Some people may say, Ian, you're too aggressive. Ian, you should be looking at trailing. Trailing, though, just doesn't give me a picture of the future. Gives me a picture of the past, and I care about the past, I care about track record, I look at that when I'm evaluating a stock, but once I own a stock, the situation I'm more or less in now is I own 41 stocks, and I'm just adding to the stocks I own. I pick up a new one from time to time, but I'm mostly adding to stocks I own. Because that's the case, I just want to look at what's the PE going forward for those stocks when I'm allocating capital. It helps me make wiser decisions. I don't care about the past so much as what's the real-time PE or the forward PE. So that's why I'm looking at it. Anyways, IBM payout ratio, by the way, is only 45%, so they have a lot of room to raise the dividend. The way I get the payout ratio is I take the dividend, the annual dividend, and I divide by the forecasted EPS for 2019. So they got a lot of room. Now, they came in at $3.17 earnings per share, and they beat analyst estimates by 10 cents. The analysts were estimating 3.07, so they beat by 3.3%. By the way, they're also up versus last year, which was 3.08, so they beat the earnings per share from a year ago as well. I read in one of these reports online now that the EPS has beaten the analyst estimates every quarter now for 2 years. This is another straight Flexin moment because IBM, for whatever reason, the investing community, the analysts, a lot of people probably watching right now, they don't like the company. The reason they don't like the company is they think, oh, this is just an old world company. Wait a minute, I don't see a lot of ThinkPads anymore. They must not be doing well. But what a lot of people don't realize is this is a business-to-business company. They deliver back-end solutions that power, for example, a lot of the financial institutions in our world. And so you may not see IBM every day as a consumer, but I imagine as a consumer, when you engage with various businesses on a day-to-day basis, there's IBM technology powering those businesses. Needless to say, though, people don't like the company. There's negative sentiment about it. This gets me as excited as a value investor, as a deep discount investor, as a long-term investor, because when everyone else is saying negative things, when everyone else, the media, for example, the financial media, they don't like the thing. Even the analysts don't like it. The analysts if IBM beat the analyst estimates every quarter for the last 8 quarters now, what that means is the analysts really don't think much of this company. They're basically keeping their estimates low because they believe very little of this company. They don't believe this company is possible of doing very much. And so it's another thug life moment. It's exciting to see IBM doing so well. Now, this earnings report, I'm not going to sugarcoat it. It's a little bit of a mixed bag because revenue is down 4.2% versus last year, which is in line with analyst expectations, more or less, but the revenue is declining. Cloud and cognitive services sales are up. System services were down. Now, cloud and cognitive, that's their growth driver. That's where we want to see revenue going up, so that's good. The systems my understanding is this stuff is very cyclical. We're late in the business cycle. Systems are like these big back office, like mainframes and computers. This stuff is cyclical, and we know we're kind of at the end of this bull market. We're at the end of this economic cycle. And so some of these more cyclical things, we see this with 3M as well, are starting to taper off, and so that's why systems is down. Needless to say, though, they still beat the EPS, and the EPS is growing year over year, so that's good. On July 9th, they closed the Red Hat acquisition, which I think is big. Debt is $73 billion, but $25 billion of that is related to their global financing. They actually finance customers to buy their products. So debt's kind of heavy, but what I understand of IBM is they're going to now use free cash flow, which is enormous, to pay down debt and raise dividend. They're not going to do as much share repurchases, so that's good to hear. And I'm just excited. I feel like IBM here is still a value at a PE of 10 at the dividend yield, the starting dividend yield, 4.3% yield. The reason I like this, the 4.3% yield, it's okay. It's not huge. It's not low either. It's a nice yield. But the reason I like this is they have an opportunity to grow the yield because the PE is so low, the payout ratio is low, and it seems to me the sentiment is still negative, but they're starting to turn the corner. The earnings per share is certainly turning the corner, and I think the revenue will start turning the corner as well. And so it's a company in transition. It's a company turning the corner. I think Red Hat will be really big, and so I'm excited about IBM here. I'll probably pick up a few more shares. We'll see in the coming months if it stays down at a reasonable level. So that is segment 2 for today. Comment, by the way, in the comments below. What do you think about the SIN stocks? What do you think about IBM? Would love to hear from all of you. So segment 3 today. One of my favorite subscribers, my brother out there on Twitter, he keeps sharing my videos with the media, is trying to get me on TV. That would be a dream come true. I really appreciate your support. You've been asking for a while, Ian, what do you think about GM? What do you think about Toyota? So I don't have anything on the whiteboard today, so I'm just going to go through my notes. But I do apologize that it took a while to get to your question here. And so I'm going to start off here. Why did it take me a while to get to this question? I am not very passionate about the auto sector. If you've been following the channel for a while, you know basically I've covered Ford. Out of the auto companies, Ford is probably one of my favorites, if not the favorite. The reason I like Ford is historically they've been in a strong position financially. I think they make a good quality product. The product is a product for the masses. It's not just like a luxury car, for example. It's a product that runs the gamut. It's kind of for all different levels, and mostly for the average person, the everyday person. And so I think that's generally a good thing. And so, needless to say, I like Ford. They pay us nice dividend yield. We'll get more into this in a minute. But when it comes to this sector in general, especially something like GM or Toyota, I just don't get excited. So it's actually taken me a while to answer this question because you saw how excited I am about SIN stocks. For whatever reason, I have a passion for it. I just do. I think it's the contrarian in me. I think it's the fact that the media hates it, so it makes me like it even more just because it's that contrarian in me. IBM, same kind of thing. I like it. It excites me because it gives me exposure to tech, which I desperately need, and it's just off the beaten path. It's not the FANG stock. It's not what everyone else is buying. It's honestly the kind of thing where in Silicon Valley, water cooler talk. Talking about IBM, probably as bad as talking about Philip Morris. If I'm at the water cooler, hey, I own stock in IBM, man, who knows, I get fired for that. I'm just kidding, I probably wouldn't, but people look at me real strange. Why do you own that, you loser? That's what they'd be thinking about me. It's kind of these, for whatever reason, I get excited about it because I know they're doing so much cool stuff. When it comes to cars, I love cars. I really like luxury cars. I like sports cars. I own an Audi. I used to own a BMW M3. It's probably good I got rid of it. It wasn't really a good financial decision in my life to own it at the age I did. I was a younger person and could have put that money to better use, and so I highlighted that here on my channel as a financial mistake. Anyways, though, when it comes to cars, I love cars and I get excited about sports cars, and I get excited about cars that you can kind of like modify and tune, like put on the bigger wheels, put on the Brembo brakes, lower it, do some engine mods. That kind of stuff gets me excited. But then I look at the stocks and I'm like, GM, man, that's not exciting for me. And so for me, first and foremost, as a dividend investor, I'm buy and hold forever. And so if I'm not passionate about something, I just can't do it because I find it hard to buy and hold forever, especially when times get bad. Times could get real bad. And when they do, and let's say my portfolio value gets cut in half, it's going to be awfully hard to stand by that and not only stand by it, but add more money when it's not a stock that it's a stock that I do not have passion for. And so that's why it's taken me a while to answer this question. That's why I don't own any auto stocks. I'll tell you something else. People ask me, Ian, big bank, talk about big banks. I own some banks. One of them's a big Canadian bank. One of them's a small regional US bank. I don't get excited about the banking sector, quite frankly, just like I don't get excited about autos, and that's one of the reasons I don't own them. I also think banks are going to get disrupted one way or another with cryptocurrency, and so that's another reason I don't talk about it or own them that much. I've got some exposure, though, and we'll talk about this more in a future video, but that's just kind of a preview why I'm not real heavy on banks. And so I'll tell you another related point to this. If I'm not passionate about something as a long-term dividend investor, I won't research it as much. I have to have passion to research something. I know so much about these sin stocks. I consider myself one of the foremost experts on the topic. I've written a white paper on it. I'll link in the description below. Check it out. When it comes to auto stocks, especially like GM or Toyota, would I ever want to become an expert on it? No. And so that's why I just don't own them. And that's okay as a dividend investor. I think a dividend investor, especially buy and hold forever, is a different type of investor. That kind of investor is looking for long-term cash flow that can pay the bills, and it requires a unique strategy. And because of that, I think it's okay to completely ignore certain sectors if they just aren't exciting. Anyways, I wanted to look at this because you asked me, and I really value your questions, your support, and your friendship, my friends. So anyways, let's look at what I found. So I don't think this is going to do it justice, what you wanted to see, but it's going to be a start, and I hope this answers your question. So Ford, I'm going to start out with Ford, because this is the one I would personally buy if I were buying an auto stock. They're trading at $10 and change. Forward analyst expectation is $1.39 per share, EPS. They're trading at a PE of 7.39. So these companies, they're still trading at really low PEs, but I'll tell you, they're very sensitive to economic cycles. And so here's another point. If I were to buy an auto stock, this is generally not the best time to do so in the economic cycle because the economy is doing really well. We're towards the end of the bull market, and so everything's looking really, really good. But that will not last forever, and when things shift, that PE of 7, it could jump up to a PE of 20 pretty quickly. And so anyways, they're doing a dividend of 15 cents a quarter. Sometimes they do a special dividend, which is really cool, but even on the base dividend of 15 cents, their dividend yield is a 5.8%. And so I like that about Ford. Of the bunch, Ford has the highest dividend, which I think is important. If I were to ever venture into a sector like this where I don't have as much passion or interest, it would have to be because of some special dividend opportunity. Now, the revenue is growing. Ford, when I looked at their annual report, out of all these companies, I don't know about Toyota because it's harder to decipher. It's a Japanese company. I didn't like their reporting the way I like the Ford and GM reporting. But when I looked at Ford and I looked at GM, Ford has more consistent revenue growth, so that was really nice. The debt is huge, $157 billion. I imagine a lot of that is because of their global financing, because they finance customers to be able to purchase Ford cars and trucks. And so the revenue from 2014 through 18 is up 11% when I just look at the delta. Net margins are really low, 2.3%. So 2.3% is really thin, and this is why a PE of 7 might look enticing. A starting dividend yield in the high 5s might look enticing. But the important thing for investors to be careful in this sector is when things turn in the economy, and they will sometime in the next few years. It just has to. Maybe it's more, maybe it's 5 years, whenever. When you have margins of 2% and change, things can change quickly. It doesn't leave a lot of wiggle room. It doesn't leave a lot of margin for error. And so if EPS drops, which it easily could on such slim margins, PE goes way up and the value gets eroded pretty quickly. And so it may, in my opinion, just be there's a lot more than meets the eye with these companies, and so that's something important. Now, something else with the auto stocks that I didn't like, and with Ford in particular, well, and GM quite frankly, is the earnings. They were jumpy. They didn't revenue was up into the right. That was nice with Ford. Ford was the best at this. But with Ford, the earnings per share, they did jump up and down from year to year. But looking 14 versus 18, the earnings are up into the right, which is nice. But again, it's lumpy. It jumps from year to year. And so that's something to be aware of. So moving on to GM. GM is trading at $39 and change. By the way, on Ford, I actually like their product too. The Ford that I like the best is the Ford Expedition. And I think they've done a really good job on Ford recently with the Platinum models. They've kind of dressed them up and make them more luxurious. As a luxury car guy, sports car guy, I really appreciate those kind of advancements at Ford where they're making the cars more premium than they used to be. And so I thought that was really cool. Anyways, GM is at $39. PE is a little lower than Ford's on a forward basis. It's a 5.91. This is based on analyst consensus estimates. Dividend is a little lower. It's at 3.9%. And the dividend, it's not been growing. It's been flat. As with Ford, quite frankly, it's been pretty flat. But Ford does pay that special dividend from time to time. So they've just got a nice yield in there. And so the debt is big. It's $108 billion. But most of that is due to the financing division. And revenues are growing. Not quite as quickly as Ford's, but they're up. They were $147 billion in 2018. That's versus $137.9 billion in 2014. So they're growing. And they're actually up, I think that's a 6.6% growth rate. So the revenues are growing, just not as quickly as Ford's. And so one thing worth mentioning with GM, they beat Ford on net margins. The net margins are 5.4%, so that's really good. I like a bigger net margin. That is really good because 5.4, mind you, is still a very low net margin. I like companies in general that have net margins like a 15% or higher. Just leaves more wiggle room. These low net margins in the auto industry, I just don't like it. It leaves very little room for error. Now, one thing worth mentioning though, GM, net income, it was negative in 2017. They lost money. This company lost money on a GAAP basis in 2017. And so like I said, the revenues for these companies, they're all right, but the net income, it's been jumping around. And for GM, it actually swung negative in 2017. And so that's something that concerns me about GM. I think where GM is stronger than Ford is on the net margin. I think Ford is stronger on product lineup, although I don't know much about these types of autos. I just know from myself, hands down, I would go for a Ford vehicle over a GM vehicle. But I know there's other people watching who are probably like, Ian, you're crazy. I'd always go for the GM vehicle. And so it's really personal preference. But I think that their lineup is stronger. And again, I have to invest where I have passion. But needless to say, I'm going to pass these companies. They're just not for me. The only time I would buy an auto company is if Ford ever got down to like $2 or $3 a share again. Then I would look at it. And this would have to happen in a financial crisis, a crash situation where people just aren't buying cars. One thing I want to point out here, if anyone's analyzing this industry, this auto industry, something important to be aware of is these companies like Ford and GM, huge amount of debt. Why is it so big? They've lent a lot of money to consumers at low interest rates to buy these cars. Now, when the economy turns sour, what if consumers cannot pay their bill anymore? Well, Ford probably can work with them on their credit, try to make it work out, or GM can do the same. But what if it just does not work out? Well, Ford and GM, they're stuck repossessing these cars. And what are these used cars worth? Nothing. And so this is the challenge, quite frankly, with these types of companies. The risk is that everything looks good now, but the economy is really good now. When it turns and these price-sensitive consumers cannot pay their auto bill, I'll tell you, if you're a consumer, just think about it. You've got a few bills a month. You got to have a roof over your head. You got to have food. You got to pay for your gas, your electricity, your cable, and you got to pay for your car. Out of everything I just mentioned, car payment is last. Of course, you want to have a roof over your head first. You want to have food first. You want to have utilities first. You know, all that good stuff. And so what it means is if a consumer's budget is tight and they can't make a payment, they're going to forego their car payment. They may even lose the car. Now, I feel bad. I'm not trying to sugarcoat this or make light of that. Of course not. I would never want someone to lose their automobile. That's awful. But unfortunately, this is all too often what happens. There's a lot of consumers that are very aggressive with their finances, and they, unfortunately, when the economy turns, if they hit hard times, there's not a lot of buffer. And so the car payments, it could become a lot of trouble for these customers, these consumers. And what it means for Ford and GM and other auto companies is really bad times. So where you're making like a 2% or a 5% margin, all of a sudden that margin's gone and you're losing money pretty quickly if people aren't paying these bills. And you're taking on all these used cars that are basically worth nothing. And so and of course they're not worth nothing, but I'm just saying when you drive a car off the lot, a brand new car, it loses, I think, about half its value or so that minute, or some huge number. And so that's what I'm trying to say is these used cars, it's not worth very much, and it's going to be hard for Ford to resell those used cars, in my opinion. And so moving on to Toyota. This one is trading at 130 bucks. It's a Japanese company, so the reporting was a little bit different. I don't have a forward estimate on this, but the trailing 12 months PE was a 7.95. They pay 2 dividends per year. The last two total up to $3.50 in US dollars. Their current yield, the yield on those last two payments, is 2.7%. I stopped right there. One, I'm not passionate about this sector. Two, I'm not passionate about something, I'm not going to spend the extra work as an investor to decipher the Japanese reporting that comes with Toyota. And so right there, and the dividend yield's like only a 2.7. It was just when I looked at their annual report, it didn't have all of the statistics I'm used to seeing in the US-based reporting. And so there's nothing wrong with that. Let's say I was really passionate about this sector. Maybe Toyota's a really good one because it's a good way to diversify internationally. I like international companies. I've talked about this a bit on my channel. I like companies that have a lot of revenue coming internationally. I'm a global investor. I look at it as one globe. I want exposure everywhere, and I think that's really cool, really important. I really like that. But again, this sector, for the reasons stated, it's just at that point, I just knew, hey, Toyota, I'm not going to look into it too much more. And so in summary, for the auto sector, I'm not really excited about any of them right now because I think we're not at the right time in the market. If the time were right, if the collapse had happened and Ford is at like trading at $2 or $3, sure, that looks interesting to me. At that point, by the way, Ford will probably have suspended its dividend. But at $2 or $3, the opportunity is a huge yield on cost if the economy improves and they're able to pay dividends again. And you can look at the history. This is what happened last time. People who bought during the last crash in Ford, they were just doing fabulous, just amazing. And so one other thing that scares me about all this stuff is the huge amount of debt related to their lending to consumers to buy cars. Now, you may say, Ian, but IBM you talked about has all that debt and they're lending $25 billion. Difference is IBM's not lending to consumers, they're lending to businesses. And these businesses need IBM software, products, hardware, mainframes. They need this stuff to operate their business. And so even if the economy goes sour, these businesses are generally going to make good, in my belief, on the IBM loans. Now, do I like the fact that IBM has all those B2B loans? No, I don't like that fact. In fact, this got GE, a really poor example of a company, one that's done very poorly, into a lot of trouble with their GE credit. And so hopefully IBM's underwriting is a lot stronger than GE's. Time will tell. So far it has been. I'll tell you another one. I own Caterpillar. I talked about this in my last video. They do a lot of these loans too. Here's the difference though. Caterpillar, if times get tough, they made these loans to businesses to buy Caterpillar equipment. Let's say the economy collapses, the businesses can't pay their payments anymore. Caterpillar has to repossess their heavy-duty equipment, their cranes and their bulldozers and their diggers and all the stuff their steamrollers, all the stuff they sell. That stuff, in my opinion, does not depreciate and lose value the way that an automobile does. That stuff has real business use for a long time. The technologies aren't changing that quickly. It doesn't really matter what it looks like because the types of businesses using these equipment is to get a job done. Whereas someone buying a Ford vehicle, they want to have the new model, they want it to look nice, it has to look a certain way, it has to be a certain color, it has to be of a certain trend. It's different. And so the way I look at it is, yeah, it's not ideal that Caterpillar lends out money for businesses to buy their product. They're in the same boat as IBM, but in general, I look at those loans as just a little bit more secure than the types of loans that automobile companies like Ford or GM are making. And so just an interesting parallel there to keep in mind. All right, everyone, this is a long video today. I hope you enjoyed all 3 segments. I know today's was a little different, got a little passionate on this stuff. Hope I didn't offend anyone. It's all good. Please comment below what you think. Your support, your thumbs up, your likes, it means the world to me. The subscriptions. I am putting all my best content here on YouTube for free. I love you guys. Thank you for the support. We are 30,000 dividend investors strong. Again, I hope I didn't offend anyone because I really do love each and every one of you out there. Even if you have a completely different viewpoint on this stuff, all viewpoints here are respected and included because it's the debate that makes us all smarter. It's the debate that gets us all second-guessing ourselves, thinking different ways. As long as we all just respect everyone's viewpoints, all of the opinions, that's what it's about here at PPC. Ian. In terms of a full disclosure, I am long the stocks mentioned today. I am long Caterpillar, ticker symbol CAT. I am long Apple, ticker symbol AAPL. I'm long 3M, ticker symbol MMM. I am long IBM, ticker symbol IBM. I am long Philip Morris, ticker PM. Long BTI, ticker symbol BTI. Long Altria, ticker symbol MO. I own all of them, all of those stocks in my personal dividend stock portfolio. And in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market, please consult a licensed financial advisor first. Literally just sharing my journey here on YouTube for fun and entertainment. All right, everyone, long video today. I'll see you in the next one. Thank you for your support. Have a wonderful day.